I would just ask any one of you, but I'll turn to Dr. Dahl first. Is my math right?
During a Senate Budget Committee hearing in March, Jeff Merkley delivered a sharp critique of a proposal that has been quietly gaining attention in policy circles: the idea of investing the Social Security Trust Fund into the stock market. At first glance, the proposal might sound appealing. After all, the stock market has historically delivered higher returns than the government bonds currently used to fund Social Security. Supporters argue that allowing the trust fund to tap into equities could help close long-term funding gaps and strengthen the program for future retirees. But Senator Merkley wasn't buying it, and his concerns reflect a broader skepticism about mixing retirement security with market volatility. He warned that tying Social Security to the stock market could fundamentally change the nature of the program. Social Security was designed as a guaranteed safety net, a predictable, stable source of income for retirees, disabled Americans, and survivors. It is not meant to behave like a 401k, rising and falling with the ups and downs of Wall Street. Merkley emphasized a key risk: market uncertainty. While stocks tend to grow over time, they can also crash, sometimes dramatically. If a downturn were to hit at the wrong moment, it could jeopardize the financial stability of millions of Americans who rely on Social Security as their primary source of income. Make sure you listen till the end, otherwise, you might miss it when it cuts off.
I have a little different view, and that is that over time it's had elements both of an insurance program and elements of a savings program. And that's been part of the challenge of analyzing Social Security and deciding how we modify it, is what element one really emphasizes. I want to go back to the idea of borrowing and investing. And just from my perspective, a cautionary note. 1.5 trillion, if you borrowed at 4%, because you forego the 4% earnings, roughly that CBO's estimate is about 4% going forward, and you get a return of 8%, you have a net improvement of 4%. So 4% on $1.5 trillion would be $60 billion. So $60 billion is only a fraction of the roughly $500 billion deficit we'll have in 2033, and it's even smaller component of the deficits that we'll have going forward. By 2036, so just 3 years later, we're over $600 billion estimated deficit. So we're talking about that plan, even under a positive scenario, addressing only 1/10 of the shortfall. But then there is the risk factor, and the risk factor is significant. And that is, if we have a 10-year period in which the stock market does not go up, and we did have that from 2001 to 2011, then basically we're talking about zero earnings, but we're foregoing, because 4% compounded is 48% over a 10-year period, and therefore we're foregoing 48% income on that $1.5 trillion and getting zero income over the stock investment. And if you have a complete collapse of the stock market, and many analysts now will note that the price per share compared to earnings is at a historic high, and there's a lot of fretting over whether we're at the high point of a massive bubble. If we gamble the Americans' Social Security program, and we end up, in fact, seeing we're at the top of a bubble that bursts, then we're really in the hole. So I would just ask any one of you, but I'll turn to Dr. Dahl first. Is my math right? On the 4% net gain on $1.5 trillion would be $60 billion per year.
That sounds about right, yes.
Yeah. And $60 billion is only about 1/10 of what our projected deficit would be in 2036.
That's right.
And therefore, even that idea would be a contributor, perhaps, to a broader plan, but it would take many other elements to put together in a package if we're really going to address the entire deficit.
That would be correct.
And that if you put the money into the stock market, you are accepting a higher risk profile, We never know whether we're going to be at the bottom point of a historic surge or we're at the top point of a bubble, but if we're at the top point of the bubble, we could end up in a far worse position than if we had simply taken the 4% return on putting it into bonds,
That's also correct.
treasury bonds. And if, in fact, we borrow additional amount, that borrowing additional amount generally drives up, to some degree, the interest rate that you have to pay to borrow, not just on the marginal amount that you borrow, but on the entire amount you're borrowing as a nation.
That's right.
And also that if you have maxed out what Americans are willing to essentially lend to the government, then we're talking about borrowing more from foreign countries.
That would be correct.
Okay, thank you very much. I'll turn this back over to Mr. Johnson, but I just want to Senator Johnson, I just want to conclude with, it's really going to take bipartisan work. We come to this conversation with different frameworks for what Social Security is. Is it an insurance plan? Is it a savings plan? Different concepts of fairness. We're going to have to really work to overcome or merge our different frameworks into a solution, and the moment demands that we succeed in doing so because we need to fix this. Thank you.
And that's really the heart of his argument. Social Security is not just another investment fund. It's a promise. He also raised concerns about political and economic consequences. Injecting trillions of dollars from the Social Security Trust Fund into the stock market could distort financial markets, increase government influence over private companies, and potentially open the door to political interference in investment decisions. Another issue is fairness. Wealthier individuals already benefit more from market-based retirement systems because they can afford to take risks and wait out downturns. Shifting Social Security toward equities could widen inequality, exposing lower-income retirees, who depend more heavily on guaranteed benefits, to risks they're less equipped to handle. Merkley's criticism also highlights a broader debate in Washington: how to fix Social Security's long-term funding challenges. While some lawmakers push for structural changes like privatization or market investment, others, like Merkley, argue for more traditional solutions. These include adjusting payroll taxes, lifting the cap on taxable income, or making targeted benefit changes. In his view, the solution shouldn't come at the cost of stability. Ultimately, the debate comes down to a fundamental question: should Social Security prioritize higher returns or guaranteed security? For Merkley, the answer is clear. The program's strength lies in its reliability, not its potential for growth. Turning it into something resembling a market-driven investment fund could undermine the very purpose it was created to serve. As discussions about the future of Social Security continue, this issue is likely to remain front and center. Because for millions of Americans, this isn't just a policy debate, it's about financial survival in retirement. And as Merkley's remarks suggest, any proposal that puts that security at risk is going to face serious scrutiny. Thanks for watching. Don't forget to subscribe to the channel and turn on notifications so you never miss an update.